Ed Hyman says we're going from 8-ish, 9-ish, and we're going down not to 2, but we're going to 4%. What does your world do if we get an Ed Hyman disinflation?
Stocks do well. Stocks absolutely do well.
John, help me here. Do they do double-digit well? Like, do they roar?
Not in this environment, not yet, because the likelihood is that if that happens, Ed's view of 1% GDP is probably where we are in 2023, and that's still a constrained environment. But I want to make a point here.
Please.
Okay, you've got 3 Fed speakers today, okay? And if you think about it, going back to the first hike in March, every time there was an extreme sort of market response to anything that Powell said, both either hawkish or dovish, the Fed speakers come out and have moderated the tone. It's going to be very informative
Lisa,
what they say.
Can we
today.
get him on every day or like every other day? I mean, just to lighten it up.
Your people can talk to his people. So far, Julian, to your point, the other Fed officials have absolutely doubled down. They have not watered down Jay Powell's message at all. They've gone quite the other way. How does that inform your assertion, which is rather dramatic, that the growth-led rally is over? You're basically repudiating this idea that big tech can rally in the face of perhaps more economic weakness, even with a Fed that is determined to hike rates.
Well, and again, it's surprising to the extent in the last couple days how much the other Fed officials have doubled down. But what it does is when you look at yields, you know they're going up on the short end rates, but also when you think about the fact that tomorrow we're going to start $95 billion a month in QT, it's hard not to make the case that yields on the long end are going up as well. And again, as we've seen in this positively correlated stock bond world, that's a massive headwind for stocks, particularly for growth stocks.
What kind of downside are you seeing, Julian?
I would say the key here is, does the consumer hold in September? If you think about it, one of the anomalies of this year is that consumer sentiment has been absolutely abysmal the entire year, and spending has been fine. Obviously, that's one of the strangenesses about a new inflationary environment. But if you think about it, could you get into this idea, we're back to the office, we're back to school, September is challenged. That is the kind of environment, if the consumer holds in, we could be okay. But if not, there's a potential retest of the lows in store.
Well, this is the bigger question, Julian. It's not about whether inflation comes down to 4%. It's what price are you willing to pay to get inflation down to 4%. Where's unemployment when inflation comes down to 4%? What's happened to GDP when inflation comes down to 4%? Julian, it's not that easy, is it, just to say we come down to 4%, that's good for stocks?
No, not at all. And look, if we've learned anything this year, or I'd argue the last 2.5 years, is that the tail outcomes, when people talk about black swans, they happen a heck of a lot more frequently than we would have ever imagined. And that's really what you've seen to a large extent this year. And so, there's a lot of different potential outcomes as we head into the fall.
We're trying to stay super open-minded about this, Julian. Can you help us do that? The short and shallow consensus around a recession in America. How are you and the team thinking about maybe the tail risks here?
So we continue to think that you're not likely to have a recession, but if Ed's view of 1% GDP next year is correct, and we see symmetrical risk around that number, it's still going to feel for asset markets from time to time as if there's a recession. That argues for higher volatility. And then again, Ed said it a couple days ago, it argues for humility in forecasting.